Joining us right now is Gabriela Santos. She is Chief Market Strategist for the Americas at JPMorgan Asset Management. And Gabriela, let's talk a little bit about this. All of a sudden, with the wobbles in the market that we've seen, with the concerns yesterday that kind of played out, people are saying if Jay Powell offers some surprise or makes it sound like it's going to be tougher to get to a rate cut, that could be something that really shakes the market's confidence, especially ahead of a Jobs Friday number.
And we are getting a lot of questions on whether the equity market has sustainably decoupled from rates, as has been the case really for the past month and a half or so as yields moved up, but stocks hit all-time highs. We think as long as Chair Powell doesn't really shift the narrative of the past few weeks, then yeah, stock markets can continue to do well while rates remain at a more elevated level. And that's because ultimately we're just talking about a slightly delayed and more gradual pace of rate cuts. We're not talking about rate hikes being back on the table. So I think it's much more digestible to be in a high for longer environment rather than the higher for longer environment that we had talked about last year. So the uncertainty about the cost of capital has decreased, and you can see that in corporate behavior too.
Does it change because this is an election year? Does the market get more nervous that the cuts won't come later because the Fed won't want to look political?
So we've looked historically since the 80s, and the Fed has actually moved in all but one presidential election moment, which was 2012. They've hiked 5 times, they've cut 5 times. Oftentimes it is just continuing a cycle of hikes or cuts, but it hasn't precluded the Fed from acting based on the data and based on where they were going anyway. Now, look, I don't think they're going to want to move right before or right after the election, but I don't think it takes a June cut off the table, which is our base case, and then another cut later on, perhaps September and December.
Go ahead.
No, I was going to say that if inflation's 2%, they should be at 4%. If inflation's 3%, there's no reason to do anything. So it all depends on what happens. And
still on inflation. And another
but why would you cut? What, wouldn't you? Yeah. We normalized it after all those years where it was ZERP and crazy and negative interest rates and all that. So we're finally in a position to have some dry powder and to get back to more normal. In that last mile,
and the economy looks strong.
The economy's strong. And that last mile with wages and a tight labor market, it might be really, really hard. So why even expect any cuts until you know we're going to 2?
I think that the question is, the Fed, and really Chair Powell is going to want to paint this today as not being at the cusp of an easing cycle, but being at the cusp of a normalization cycle. Meaning, unless something big changes on productivity or if inflation remains permanently sticky, neither of which is our base case, then 5.4% on short-term rates is too high. So it's really trying to come back to what we could argue is a more neutral level of interest rates, something closer to 3.5%, or about 100 basis point real rate. So you think
we're still in the new normal, like to use Mohamed El-Arian's phrasing, that this is the new normal?
Old new normal.
Yeah.
In the sense of not bringing rates back down to 0 or having negative rates. I think that was a chapter we closed post-GFC, pre-pandemic. It's more a return to what was normal before, which was positive real rates, but also not 5.4% interest rates. And if you look at what's priced into the futures market, it is a pretty shallow rate cutting cycle at this point. We've had a good adjustment of expectations for this year, for next year. And the ultimate resting place right now that's being priced in is 3.6% by the end of 2026. So the market has really come around to this idea that the economy is not tanking and this is just normalizing.
We argue all the time about whether we're actually restrictive right now. And given the, well, maybe we'll know more on Friday, but have we seen any signs that we're restrictive right now? And if we're not restrictive, then there'd be no reason to even think about cutting. You think we are restrictive. 5.4, you think we could be, you think 2's in the cards. So that would be maybe two cuts, maybe is all you need or something.
I think this is the most interesting discussion, is what the new equilibrium rate's going to be.
Yeah.
For now, the Fed is still at 2.5, but if you look at the dots, some members have started moving their estimates closer to 3% on overnight rates. I think the market has settled on 3.6, that kind of area. There's been some good improvements on the productivity side. There's been a recent increase in immigration, so an uptick in expectations for long-term growth. I think the debate is still more on the inflation side. In our view, inflation continues to normalize. It's going to be really important to see the February data. The January data was really strange, a lot of seasonality, a lot of nuances between different measures of rent. But if inflation continues to normalize towards 2% by the middle of the year, based on our expectation, then there's no reason to think that rates too high above 5% make sense.